In this video, I'm going to be talking about your DTI, your debt to income ratio. This is an important topic because this is one of the main reasons why I couldn't get approved for a mortgage loan a few years ago. If you're thinking about buying a house, stay tuned to the end because you don't want to make the same mistake as me. Aloha everyone, my name is Hazel Gacula. I'm an entrepreneur and real estate agent here in the beautiful islands of Hawaii. If you're new to the channel, don't forget to like and subscribe. I'll be posting up more videos about real estate to help you get the keys to your new home. What is the debt to income ratio and why is it so important? Well, it is one of the biggest factors to qualify for a mortgage loan. A few years ago, I was so close in getting pre-approved for a mortgage loan. I worked at my job at the time over 2 years. I had great credit and I had enough money for a down payment. But my debt to income ratio did not qualify, which screwed me up. I couldn't get approved for a mortgage loan. Your debt to income ratio is all of your monthly debt payments divided by your monthly gross income. Let me say that one more time. Your monthly debt payments, which could be your car loan, your personal loan, your credit cards, or if you have a previous mortgage loan, anything that gets recorded to your credit report. Don't include your cell phone bill, don't include your electricity bill, only whatever is reported on your credit report. Okay, let's do some simple math. Let's just say all of your monthly debt is $5,000 and your monthly income is $10,000. That means your debt to income ratio is 50%. This percentage tells the bank how much you can afford to pay every month and to see if you would be a good credit risk. If the bank see that you have a lot of debt and low income, there's no way the banks will lend you money because they'll know that you'll be struggling to make those mortgage loan payments. Your DTI ratio should help you understand your comfort level with your current debt situation and determine your abilities to make those payments on any new loans that you may borrow. Okay, so let's do a realistic number. I got my whiteboard right here. So let's just say, where did I put my pen? Okay. Let's start off with, what is your gross monthly income? I hope you can see it. Okay, so let's start off with, what is your gross monthly income? So whatever you made last year divided by 12. So for this example, let's just say last year I made $60,000. $60,000 divided by 12 months equals $5,000. So that $5,000 is my gross monthly income. Okay, now jumping into the credit cards. With the credit cards, you're only adding up your minimum monthly payments. So for example, my Discover and Chase card, I pay $200 a month, but my minimum payment is only $50. I'm just paying extra. You want to just add up all of the minimum payments because that's what the banks are looking at. So for credit card bills, I put $150. I'm going on to the personal loan. Let's just say your personal loan is $200. For the car loan, let's just say you have like a Acura TSX. Your monthly payment's probably, what, $350? I don't know. And then for your student loans, let's just say $300. Okay. So adding all of this up, this equals to $1,000 of your monthly debt. We just found out what is our gross monthly income, which is $5,000, and our monthly debt payments, which is $1,000. Okay, so what you want to do is divide $1,000 by your gross monthly income, which is $5,000. So this equals to 0.2. To make this a percentage number, you want to times it by 100, then it equals to 20%. All right, so 20% is your DTI without your mortgage loan. So let's just say you were thinking you could afford a $1,500 mortgage loan because that's how much you're paying for rent right now. Whoops, looks like I lost audio. But anyways,
So we're gonna add $1,500 plus $1,000 of the debt that we already added up earlier would equal to $2,500.
Divide this by 5,000. This equals to 0.5. Again, we're gonna times this by 100, which will equal to 50%. So your debt to income ratio with your mortgage loan, if your mortgage loan is $1,500, would be 50%.
With a 50% DTI ratio, you should take actions to improve it because lenders may limit your borrowing options. With more than half of your income before taxes going towards your debt payments, you may not have much money left to save, spend, or handle unexpected expenses. I'll put a link to a DTI calculator in the description so you can play with some numbers.
As a general guideline, 43% is the highest ratio that you could get approved for a mortgage loan. Ideally, most lenders prefer you to be lower than 36% in the debt to income ratio. But the maximum DTI varies with different lenders. However, the lower your debt to income ratio is, the higher the chances of you getting approved for a mortgage loan. So now that we know our goal is to be below 43%, let's just say our monthly mortgage payment is $1,200. $1,200 plus the $1,000 we already pay every month equals to $2,200. Again, we're gonna divide this by $5,000. This equals to 0.42. Again, times 100, we get 42%. So now you probably have a better idea what is your debt to income ratio. I didn't get approved for a loan at the time because I took out a $30,000 loan for a friend to help him run his business. He was supposed to pay me off within a year. That's why I agreed to it, but it ended up taking 3 years to pay me back. Because I took out that loan under my name, it's gonna be calculated within my debt to income ratio. Even though he's making the payments, it's still underneath my name and it's reported to the credit. So if you want to become a homeowner and build wealth, do not take out any loans for anyone, not even your friends, your family. I want to end it on a good note to put your dreams before anyone else. Alright guys, thank you so much for stopping by. If you found this video helpful, don't forget to smash that like button. And as always, if you ever have any questions, don't hesitate to reach out to me. Hit me up on Instagram. I'm pretty active on there. And while you're at it, go ahead and follow me on the rest of my social media. And I'll see you guys on the next one. Take care.